How we doing? How we doing? Today is Thursday, February the 27th, 2025. Just continuing our series here on real estate notes and seller financing. Um, if you want to see there are other two videos where we kind of, lay the foundation on what seller financing is and what real estate notes are. You can go and check that out at Abundant Capital Group YouTube channel. There's a playlist that says Real Estate Notes and Seller Financing 2025. You'll see the last 2 weeks that we did. This is the third video in that series, and we're just going to break it down piece by piece. Seller financing, quick review, is just when a owner of a property actually finances the purchase for the buyer. That's just a short definition on it. And then what is created is a real estate note in a mortgage or some type of security agreement. Those security agreements can be sold, can be liquidated. Um, you can do a full liquidation, sell the whole note, or you can sell a partial of the note, just depending on the type of money that you're looking for. So we're not going to get too far in the weeds on that. That's just like a quick review. But if you watch those videos, have any questions, please reach out to me. My telephone number is 973-475-8488. And my email, investorgmr@yahoo.com. But this week, we're going to continue and we're going to talk about buyers and seller financing. So let me share my screen here. And I think it's here. Um, yeah, I think this one is it. So, why buyers need seller financing? Again, there's my contact information. And, again, we're just continuing the series that we have on real estate notes and seller financing. So here are some of the reasons why a buyer, would look for seller financing. Last week we talked about why a seller would do it, and this is some of the reasons why a buyer would do it. No costly loan fees. If you've ever purchased a property and you look at your, HUD statement, you look at, all of the fees that are associated with originating a loan. You have doc prep fees, closing cost fees. You have things like junk fees, origination fees. So a lot of this stuff, adds up when you go to a traditional lender or financial institution looking for a mortgage, and that just adds on to the closing costs and everything that goes along with getting a loan through a traditional source. So we can kind of get rid of those fees once you do. Um, as a buyer, if you're looking for someone that is offering to finance you the seller financing. No PMI. A lot of times, if you're not putting down 20% or more on a property, the lender is going to add on PMI premium. And I've seen PMI premiums get pretty expensive, and I can only imagine what they're going to be now as we move forward with this new administration. Um, as I mentioned before, some of these other fees um, that you pay when originating a loan, I should say, a lot of those protections are going to go away with this new administration. So, lenders are going to be able to charge whatever they would like in order to originate a loan. So a $250,000 loan, which is probably, below average right now, but just for an example, could add anywhere from $100 to $300 additional payment. So if you can, as a buyer, and work with somebody that was offering seller financing, you can save yourself, and that could be the difference between making, stretching on having to make your payment every month or, feeling comfortable that $100 to $300. And in some cases, it could even be more than that. When it comes to seller financing, we're less restrictive in the underwriting. I know over the last few years, things have been, pretty strict. The Consumer Protection Agency was kind of making sure that, consumers get protected when going for a loan. Now, like I said earlier, that is going away, but there is less restriction when you're dealing with a homeowner that's offering seller financing. Um, where like the down payment comes from, a lot of times when you're dealing with a traditional lender, you may have to source those funds. They may have to be in your bank account for a certain amount, or if you're getting it from somebody, then they need to know where it's coming from. So with seller financing, you don't necessarily have that much scrutiny over, the amount and where it's coming from. Credit scores, right now, people that are not at about 680 or above, those people are getting that prime rate, which is, I guess, as of today, maybe around 6.7%. But if you have a credit score under that, you can anticipate, paying, a higher interest rate. So when it comes to seller financing, we're a little bit more relaxed on the actual credit score. Maybe that's the issue that you're having with getting qualified. Maybe they're telling you you have to get your credit up to a certain level, but not necessarily you don't necessarily have to have it, at 720 or above, or have that A plus credit when a seller is offering seller financing. Now, we're not gonna put a seller in a situation where somebody has, awful credit and has a lot of issues, because we need to protect them, um, in this transaction, that they want to make sure that the person can pay and shows a good history of paying. But sometimes things happen, things come up on the credit. It may be something that happened relatively recently within the last 24 months, and it has not been taken off of your credit or something like that. But we can be a little bit less restrictive when it comes to your credit score. You don't necessarily have to show 2 years of W-2s, like a traditional lending institution. Maybe you started a job and you've been there 6 months, maybe, close to a year, something like that. And maybe that's the reason that you're not getting qualified by a traditional lending institution. That, we're less restrictive on, the W-2s and where the money where you are making money, where your money is coming from. A lot of times people are gig workers now and things like that. Maybe you picked that up relatively recently. You don't have an extended time of driving Uber or, doing some type of side hustle. So again, we will not be as restrictive. We won't be as harsh when looking at those particular things. So, self-employment, a lot of times, people that are self-employed, you don't, maybe you didn't file the taxes because you're trying to get things situated, in terms of getting certain write-offs and certain things together, and maybe you didn't file the last 2 years. Maybe you had to get an extension or something like that. And then also as a self-employed person, you're trying to make sure you have as many write-offs as possible, so you don't have to pay a lot of taxes. So when looking at that, we can be a little bit more favorable to someone that's self-employed and get them into a property. Debt to income ratios. We really don't want to be, at this 50%. But, we can be, a little bit more giving on the debt to income ratio when it comes to seller financing. So again, maybe that is a reason why the lender is not, um, qualifying you. And if you were to able to get in a situation where, we could help you structure um, this transaction, we could be a little bit more giving on that debt to income ratio. Also, another issue with buyers is that they have a number of properties. Maybe you're somebody that, self-employed, has a number of properties, investment properties. Um, banks they get a little skittish on that because you have a lot of responsibility on these other properties, and that could affect you making your mortgage payment. If you have four or more properties in your portfolio, and maybe that's how you make your money. The banks sometimes don't want to qualify you in that circumstance. So all of these things here are just different reasons why issues that potential buyers could have. And you're seeing a lot more of this now come up because of the credit availability. Let me go to that real quick before I come back to this. Where's my, oh, yeah, let's see. Uh, Let me Google this real quick and show you this. Mortgage credit availability index. So this is a chart here. Uh, Let me go back to sharing. Uh, where is that chart? I'm trying to find the chart. 1 second chart. Where is the chart? It's usually easy to find. I'll get the report. No. Index. I'm trying to look for the chart. I can't find it right now. But there's a chart of the mortgage credit availability, and right now the mortgage credit availability is very low. It's at some of, the lowest that it's been in a long time. Um, so that just means that banks are not, giving out money like they once were. So they're being a little bit more restrictive right now. Taking, the best of the best, so to speak, and getting those people qualified as opposed to maybe some other people that have that under 680 credit score in different situations like that. So the last thing on this on my presentation here is favorable terms. We can be very favorable when you do the as a buyer and you get yourself into a situation where the seller is financing you. You can get favorable terms depending on your situation. There's a little bit more negotiation that can go on when it comes to the terms of the loan, in terms of how many months. Maybe we can lessen the months. Maybe we can increase or decrease the rate. There's a lot of things that can be played with when it comes to dealing with the seller of a property. So, I just wanted to like real quickly just kind of go through that presentation because a lot of people, think that, they may not know that this opportunity is out there. If you're somebody that has gone and tried to get qualified and you didn't get qualified for a bank for X amount of reasons, whatever they may be, maybe reach out and let's see if we can get you in a situation where, if the seller is amenable to, doing the seller financing, we can kind of structure that on your behalf and get you into that particular property. And then there's things that we can discuss with the seller on their end um, to make sure that they get the money that they're looking for in this transaction. So there's things that we can do on that side as well to help both parties. So if you know someone that got denied, but is looking. Maybe they're sitting on the sideline because of everything that's going on, but they're in a position to buy. Please reach out and let's have a conversation. There are properties out there, and I'm not just talking about in the Northeast where I am. I'm in New Jersey. If you see this and you're in Texas, if you're in Georgia, if you're in California, if you're in Seattle, wherever you are, these potential deals are in every market. You have people that will, do the financing, seller finance a property to you, and then, we can just help structure it so you're in a good position, the seller's in a good position, and then, if the seller of that particular property, if because they didn't sell it a traditional way and get all of the cash that they were looking for at the time of the sale, there's a way that we can get them the money that they're looking for within a reasonable, amount of time or a certain amount of time that they'll allow us to get that to them. So things that can be structured. If you're a realtor, you have buyers that, deals have fallen through. If you want to reach out as well, we can help structure between that seller and the buyer that you have, depending on what side of the transaction that you are on. We can, structure this in a way um, to satisfy again both parties. We bring them together, we structure the deal, and make sure the buyer can get in there and make the payment. Seller, gets what they're looking for. Obviously, they're not going to get it right at the closing, but hopefully within a certain amount of time, depending on their situation, we can get them what they are looking for. So it's just another good tool to have when you have a situation that is not like a traditional type of situation. If there's problems that arise in a transaction, you can use this note strategy or seller financing strategy as a way to um, solve the problem for the buyer and the seller. If you're an investor, if you have properties, I would definitely look at seller financing as opposed to renting a property. With the increase in expenses, increasing insurance, all these, other expenses that are on the property. If you have to, fix something, the cost to, get a handyman and materials and stuff like that has gone up considerably. If you start to see like you're not getting the same cash flow, from 2000, let's say 22 and 23 and 24, it's different because things have gone up. You want to look at creating a note or doing seller financing on that particular property. A lot of times we can double, if not triple, the cash flow for you. And, you're in a position where you're not responsible for any toilets or tenants, any expenses and things of that nature. So it's something to look at. So again, we just want to kind of take this piece by piece, and go through what seller financing is, what is creating a note from that it can help sellers, it can help buyers, it can help investors, it can help realtors. So we're just kind of going through that whole piece, um, week by week. Next week we'll do of pros and cons of seller financing. You know, there are some things that you have to guard against if you're a seller, things that you have to guard against if you're a buyer. But a lot of times those are, minimal things, things that are not, they're easily overcome when these things are structured the right way. So hopefully you'll join me next Thursday, 8 p.m. Eastern Standard Time. Please follow me on Facebook, Instagram, as well as YouTube. I'll post a link, on all of those sites. And if you can't catch it live, you can always go to that playlist, Real Estate Note, I think it's Seller Financing and Real Estate Notes 2025 on the YouTube channel Abundant Capital Group. You can go there and get the video. All right. Thank you for joining me, and I appreciate it. And we'll see you next week.